Over the past few months, I've had the same conversation with several different people. Different islands, different properties, different stages of life. Someone who's inherited property but split between family members who finally feel like it's time to sell and move on. Someone who bought years ago and watched the value grow beyond anything that they expected and wants access to that equity without taking on more debt to get it. Someone whose short-term rental stopped making sense after the rules changed. And someone else who's just tired of tenants, tired of repairs, tired from being on call from a property that they were supposed to stop thinking about years ago. Different stories, same place they want to sell. And then they think about the taxes and they stop. Stuck between a property that they no longer want and a tax bill that they are afraid to trigger. In one of those conversations recently, I asked a simple question, to go beyond the numbers. What would it mean to sell everything and receive a check every single month for what you need to live? The answer was not words, it was a long exhale and an idea that they really needed to sit with. If any of this sounds like you, this video is the conversation that I keep on having. There are 4 ways out and most people really know only 2. And one of them, it's getting a lot of extra attention right now that I think deserves an honest explanation. The real pros, the real cons. My name is Ethan Ho, a certified financial planner and founder of Cloud Capital Partners here in Hawaii. I help people navigate exactly these types of decisions where taxes, real estate, retirement, they all collide at once. If you would like practical, Hawaii-specific financial planning content, hit subscribe and follow along. All right, let's get into it. Before we get to the 4 options, let us be honest about the problem. Because the fear, it's not irrational. The tax bill held on a long-time Hawaii rental is real. And it is bigger than most people think. It's not one tax, it's 4 stacked on top of each other. Layer 1, depreciation recapture. Every year you own that rental, hopefully you took a depreciation deduction, whether you noticed it or not. And when you sell, the IRS wants that back, taxed up to 25% federally. And for a property that you held for decades, this is often one of the biggest and most surprising layers. Layer 2, federal capital gains, up to 20% on the growth itself. Layer 3, net investment income tax. That's another 3.8% for higher earners. Layer 4, Hawaii, 7.25% in state capital gains tax. So let's make that real with round illustrative numbers. Say you're sitting on $1 million of gain, and you took $300,000 of depreciation over the years. Recapture on the depreciation, capital gains on the rest, then investment income tax and the state of Hawaii. The combined bill can land somewhere around $300,000 or more. Roughly a third of your gain gone at closing. This is a real problem and the fear makes sense. So let us walk through the possible solutions that are worth considering. When you own highly appreciated investment property and you're ready to be done, you have 4 real options. Door 1, sell and pay the tax. Door 2, hold until death and let the step up in basis erase the gain for your heirs. Door 3, a 1031 exchange into property that you choose and manage. Door number 4, a 1031 exchange into something called a DST. This is where you can own real estate, but nobody's calling you about it. So same tax code, but 4 very different lives or paths to choose. Let us walk through them honestly. Door 1, I think it gets dismissed too quickly. Sometimes just paying the tax is the right answer. If your gain is modest, your depreciation recapture is small, if what you value most is being completely and permanently done, you pay once, but you walk away with cash. No structures, no timelines, no new paperwork, full liquidity, and total simplicity. Every deferral strategy that I'm about to describe, it comes with strings attached. Door 1 has no strings, it just has a price. And whether that price is worth paying depends entirely on how big it actually is and what the alternatives would cost you in money and more. And one planning wrinkle worth knowing if you are near or in retirement, Medicare premiums are based on your income from 2 years back. So a large gain in a single year can raise what you pay for Medicare 2 years later. It's called IRMA. Not a reason to avoid selling, but a reason to plan the timing and the ripple effects before you close. So hold that thought, because at the end of this video, I'm going to tell you about someone who was pitched a fancy deferral strategy when door 1 was the right answer all along. Door 2 is the one your golf buddy told you about. Never sell, hold the property until you pass. And when your heirs inherit it, the tax basis of that property steps up to the fair market value on the day you pass. Decades of gain, decades of depreciation. For income tax purposes, it evaporates. The math is real, and for some families, it is genuinely the right plan. But there are two asterisks of the mainland version that this advice never mentions. Asterisk 1, Hawaii has its own estate tax. The federal state exemption is now $15 million per person. Hawaii's exemption is $5.49 million, and it's frozen. It doesn't adjust upward. Hawaii's top estate tax rate is 20%, the highest state rate in the nation. A couple with a home, retirement accounts here, a rental portfolio can clear that exemption without ever feeling wealthy, which means an estate could owe nothing to the IRS but hundreds of thousands of dollars to the state of Hawaii. There's planning that helps, including a spousal portability election that has to be filed within 9 months of the first death. This could be easily missed. But the point stands, door number 2 erases the income tax problem and can walk you straight into an estate tax problem. Asterisk 2 is simpler. Door 2 means being a landlord until your very last day. This step up is a powerful tax outcome, but it is also a lifetime sentence. The business of tenants, repair, management, it all stays with you for the rest of your life. And for the people who talk to me tired, that's not a plan, that is a job with a good tax treatment. Doors 3 and 4 allow you to defer the entire tax bill, but we'll take them one at a time. And then I'll help you understand the fine print on door 4 that matters most. And then to cap it off, a few other tools worth knowing about for specific situations. Before we open doors 3 and 4, I want to name the principle that makes them so powerful. When people hear the word defer, they assume that they're just postponing the bill, kicking the can down the road. But remember door 2 and the step up in basis. And the powerful connection is that deferral and the step up work as a team. If you exchange and then exchange again if you need to, and hold into the day you pass, the deferred gain gets erased by the step up. The tax you postponed never comes due. Real estate investors have a phrase for this: swap until you drop. So doors 3 and 4 are not really about paying later. Executed fully, they are roads back to door 2's ending, but without door 2's lifestyle. You get out of being a landlord, but the gain still disappears for your heirs. That is the game. And the honest caveat is that the estate tax issue that we talked about in door 2 still applies here. Deferral solves the income tax problem, but it does not solve the estate tax problem. Those need to be planned together. Door 3 is the classic 1031 exchange, named after the tax code that has been allowing real estate investors to defer capital gains for well over a century. The concept is simple: sell your investment property, buy another investment property. Follow the rules and the entire tax bill defers. All 4 layers: the recapture, the federal tax, the Hawaii tax, the net income tax, deferred. But the rules have teeth. From the day of the sale, you have 45 days to identify your replacement property, and another 180 days to close on it. And anybody who's tried to find good property in Hawaii in 45 days knows exactly how much pressure that is. The variation worth knowing that exists: a reverse exchange, where you buy the replacement property first and sell yours after. More complex, more costly to set up, but it takes the clock pressure off of the hunt. And another thing specifically for those of you who own Hawaii property but live somewhere else: when a non-resident sells Hawaii real estate, the state requires a withholding called harta, 7.25%, not of the gain, but of the gross sale price. On a $1.5 million sale, that's over $100,000 held back at closing. But a properly structured exchange qualifies as a non-recognition transaction. That means with the right forms, filed the right way, that withholding can be avoided entirely. One more reason why the paperwork has to be right at closing and not cleaned up afterward. So who is door 3 for? Someone who still wants to own and control real estate, who wants to trade up, consolidate, or just reposition. But notice what door 3 does not solve. You still have tenants. You are still the landlord. You've traded one set of problems for a fresher set of the same problems. I spoke with someone recently who had a genuinely good opportunity to exit a property. The income it was producing was low compared to what it was worth. On paper, the exchange into something better made all the sense in the world. But when we talked it through, something interesting came up. They didn't actually need more income. And there was a second problem. The property was worth so much that replacing it all at once would be genuinely difficult. It might take multiple properties and possibly across different states. which means multiple state tax returns, multiple property managers, pretty much multiple of everything. And one day, all of that complexity lands on their heirs, which changes the entire question. Because if you do not need more income, then trading into a bigger property with more tenants and more management is not upgrading your portfolio. It is upgrading your workload, which brings us to door number 4. Door 4 uses the exact same tax code section, same deferral, same rules, same deadlines. The difference is what you buy. DST stands for Delaware Statutory Trust. And before your eyes glaze over, here's what it actually means in practice. Instead of exchanging into a property that you find, buy, and manage yourself, you exchange into a fractional share of large institutional real estate. Think apartment communities, medical buildings, industrial warehouses, properties professionally managed by a sponsored company. The IRS formally recognized this valid exchange structure back in 2004. So this is not a loophole, it's an established road. So here's what it genuinely offers. Full tax deferral, same as any exchange. Truly passive ownership. No tenants call you, no repairs reach you, and no property manager reports to you. Income potential from professionally managed property, diversification, so your equity can spread across multiple buildings and markets instead of sitting on one building in one street. And one technical advantage that matters more than it sounds, exchange rules require you to replace the debt from your old property. DSTs come with financing already built in, structured so it satisfies that requirement without you personally guaranteeing anything. Remember the question from the beginning? What would it mean to sell everything and receive a check every month for what you needed to live? This is the structure that question could lead to. I spoke with a couple recently who's retiring to Hawaii and simplifying everything. Done with the property that they own in the state that they're leaving behind. They don't want to find a replacement building in 45 days. They don't want new tenants. They want their equity working and their time back. For that situation, this door is built. Now, let's talk about everything the brochure doesn't lead with. First, this is typically for accredited investors only. Generally, this means $1 million of net worth outside of your primary residence or consistently high income. It's typically a legal requirement, so not a preference. Second, this is illiquid, truly illiquid. When you enter a DST, your money is typically committed for 5 to 10 years. There is no meaningful way out early. No selling your share on an exchange. You wait until the sponsor sells. Third, you have zero control. You do not vote on decisions. You don't choose when to sell. You are along for the ride entirely. For some people, that's the entire point. And for others, it is unbearable. Know which one you are. Fourth, is fees. Sponsors charge for putting these together. Upfront cost, ongoing management, fees on the eventual sale. They vary widely between sponsors, and they deserve real scrutiny before any dollar moves. Fifth, your old tax basis follows you. This one surprises everyone. If your building is fully depreciated, you don't get a fresh depreciation schedule just because your building changed. Your low basis carries over, which means much of the monthly income arrives as taxable income. The check every month is real, it's just not as tax sheltered as most people assume. And 6, the structure is frozen by law. The same ruling that lets DSTs work that prohibits the trust from ever raising money, taking on new debt, or renegotiating major leases. The rigidity that makes it passive also makes it rigid in a crisis. If the property hits trouble, the trust cannot adapt the same way an active owner could. And now the part I promised, the fine print most DST buyers never read until after they sign. Many DSTs are not designed to simply hold property and sell it. They are designed as a pipeline. After a few years, the sponsor rolls those properties into a real estate portfolio or a REIT. Your DST interest converts into units of that company's operating partnership. This is called a 721 exchange, and it happens tax deferred too. Here's the honest truth about it. For the right person, this ending is actually good. Your investment diversifies across the company's entire portfolio, dozens of properties instead of 1 or 2. You gain an eventual liquidity path. You can convert small portions to shares over time, creating small tax events instead of one giant one. Estate planning gets dramatically simpler. Units divide cleanly between children the way a fourplex never will, and the step up at death still works, so door 2's endgame still survives. But here's what you give up. Once you convert into those units, you can never do a 1031 exchange again. Units are not real estate in the eyes of the exchange rules, so the road you've been traveling for your entire real estate investment life ends there. It is a one-way door. The way most of these are structured, the roll-up happens on the sponsor's timeline at the sponsor's evaluation, not yours. You typically do not have a meaningful vote. So here's the question that matters before entering any DST. Is this a real estate strategy or a pipeline into someone's company? Both can be legitimate, but you deserve to know which one you're signing before you sign it. Quickly, 3 more tools worth knowing exist and one warning. Tool number 1 is the installment sale. You become the bank, the buyer pays you over time, and you spread those gains over years instead of all at once. Common here in Hawaii, especially between local parties who know each other. It doesn't erase the tax, it paces it. Tool number 2 is the charitable remainder trust. For the charitably inclined, the trust can sell the property for no immediate capital gain. You receive income for life, the charity receives what remains. Narrow fit, but powerful when it fits. Tool number 3, and this one's underused. If your rental used to be your home, you may be able to combine the home sale exclusion with an exchange. Up to $250,000 of gain, tax-free as a single filer, or $500,000 married. Permanently excluded, not deferred, with an exchange deferring the rest. The catch is a window. You genuinely need to live there the last 2 out of 5 years. Wait too long as a rental and the window closes. Hawaii is full of accidental landlords who moved and kept the old place. If that is you, check your window before it closes. And one thing to look out for. There is a different product out there, marketed as a DST, but meaning Deferred Sales Trust. Same letters, not the same thing, and on much shakier ground. If someone pitches you a DST, ask which one they mean. And before I close, I owe you the story that I promised. I spoke with someone recently who had been pitched a DST. Presented as a tax solution, sophisticated, compelling, the brochure was beautiful. There was just one problem. When we actually looked at their situation, their tax liability wasn't major. Modest gain, limited depreciation to recapture. The bill from simply selling was real, but manageable. So the pitch was asking them to lock up their money for years, give up all their control, and pay sponsor fees, all to defer a tax that was never really the problem. This is the tax tail wagging the dog, something I've talked about on this channel before. The deferral strategy only makes sense when the tax is actually the thing that's standing between you and the life that you want. Sometimes it is, and sometimes it is not. Sometimes the honest answer is door number 1. Sell, pay, be done, and never think about it again. Pitching or selling a strategy before understanding your numbers is selling, not advising. Here's what I want to leave you with. This decision was never really about the tax code. It's about a different question. Do you still want to be a landlord? And what is your time actually worth in this next chapter of life? The 4 doors are just 4 honest answers to that question. Sell and pay, clean and done, hold for the step up with eyes wide open, exchange and stay in control, or exchange into something passive and get your time back. And that question I asked earlier, what would it mean to sell everything and receive a check every month for what you needed to live? If hearing that question made something in you exhale, that is something that's worth paying attention to. That feeling is information. And quick note before I go, this video is education, not advice. DSTs are securities only available to accredited investors. They involve real risk, including illiquidity and loss. Every situation here depends on your numbers, your goals, and your timeline. So before making any of these moves, work with a qualified tax or financial professional that fully knows your picture. If you found this useful, hit subscribe. I keep putting out Hawaii-specific financial planning content, and I'd love to make sure that you see it. And if you're sitting on appreciated Hawaii property and trying to figure out which door is yours, that decision sits exactly where taxes, real estate, and retirement meet. That intersection is precisely what we do at Claw Capital Partners. Head to clawcapitalpartners.com, schedule a discovery call, and I'll see you in the next one.